Imagine turning one simple investment into $1 million portfolio. Sounds crazy, right? Well, in today's video, we're going to be diving into one of the most powerful ETFs, which is the VGT. It is the Vanguard Information Technology ETF. And by the end of this video, you're going to know exactly why this ETF is so powerful and what risks you really do need to look out for with this one. If you've been searching for long-term growth and exposure to some of the biggest, most innovative companies within the planet, this ETF might be your golden ticket. Before you rush into it, let's break down exactly what it is. And I want to show you the comparison and looking at this specifically and what exactly the VGT is. Now, overall, when you start looking at this, this is the Vanguard Information Technology ETF. Now, you'll notice that there is a pretty strong year-to-date return, 12.85, but I also want to do kind of a comparison in a little bit just to show you exactly where this is kind of trending in relationship to some of the other ETFs, because I did get some feedback on the video. We were talking about the 5 best ETFs, and a lot of people were wondering why this ETF was not included. So let's break this down. Now, risk reward scale, you can see this is at a 5. This is the most risk that we can get in an ETF, meaning that it is based very heavily into the tech sector, which can have incredibly high highs, but in a market downturn, it can have incredibly low lows as well, which is something to definitely be aware of. Now, performance and fees, this is where it kind of gets interesting. So over the last and really the month end, we are sitting at 4%. 3-month total, we are at 25%. That is phenomenal. That is absolutely crushing it over the last 3 months, which again, it's been multitude of days of new record highs, record highs, record highs. We have seen it again and again and again. Year to date, we're at 11%. Then when we go to the year, so in the last 12 months, we have seen a 22%, but then you back it up to 3 years, we're at 23%. Now, again, when we start looking at 2023, 24, and 25, it has done and really performed incredibly well. When we include 2022, you can see we drop about 4% right there, down to the 5-year at 19%, and then the 10 years at 21%. So still doing incredibly well. And since inception, 13.87, which if you look, this was 21 years ago. So this is even before we seen, the housing market crash. We seen COVID. We seen really the drawbacks, a couple different years between and within that last 21 years that we've seen this ETF really perform. Expense ratio still incredibly low, a 0.09. Again, anything below probably 1% is a pretty low expense ratio. When you start getting into the 0.2s, the 0.35s, even looking at a 0.09, incredibly low. Now you notice in here the beta, it tracks the US Dow Jones Total Stock Market Index, which again, it really makes a big difference on just focusing on the IT aspect that we have within here. So looking at the closing price, $700. Again, I'm not really too worried about it. Majority of exchanges, including M1, Robinhood, everything else, you can buy fractional shares, which again, really doesn't make a big difference in there. But what we want to look at is what makes up this ETF. This is always important because of the diversification aspect. So if you're going in and you're purchasing an ETF, you're not buying one single company, but you are buying a large basket of companies, which is the reason why ETFs are so popular. And so many people, including myself, only invest in ETFs. Number of stocks, 315, benchmark at that 317 in the VGT. And overall market cap, trillions of dollars. So we know doing incredibly well. Growth rate, 31%. P/E ratio, a little bit high at about 40x, which again is a little bit high, but that's okay because we know it's tech. Risk associated with aggressive funds, definitely you have to know. And this is one where you have to ride on. Think of a roller coaster ride. It's going to have its ups. It's going to have its downs. This is a fund that you are going to hold for an extended amount of time. This is not one that you might have a year or two in. Again, could have some very wild fluctuations or some very extremely wide fluctuations, what they talk about here. And of course, being in the tech sector, we will see that in a minute when we do the comparison. So what exactly do we have in here? This is where the interesting part comes in because you'll know, and looking at this, semiconductors right here, 31%, system software, so the actual part that runs it, another 22, technology at 14, and then application at 15. So when you think about this, it is going in super heavy in that tech sector, which makes a really big difference. Then we look at what we actually hold. Now, when we start looking at the percentage of the fund, and this is again where concentration can be incredibly good and can do incredibly well. But if the market does a drawback, if one specific company within the market has a drawback or a pullback, bad news, bad publicity, something of that nature, you can see an ETF like this do a very large pullback. Looking at NVIDIA, 18% of this fund is NVIDIA, Microsoft 15, Apple is 12. So even looking that right there, you're talking 20, you're looking at 30, 40, 50, 55% of this fund is made up in 3 companies in its entirety, which again, or excuse me, 45%, a little north of 45%, is built up of this fund and just focusing on 3 companies. Now, remember, there were 317 companies in here. You have 45% of the ETF based in 3 companies. So again, a large majority is based in those 3 companies. So if you have something that, tariff affects companies like NVIDIA, chip production, selling to China, this could have a very detrimental with any really technology ETFs, not just focusing on this one specifically. This is just the video I wanted to do about the Vanguard Information Technology, but you can see where, tariffs can affect some of these companies. We can see a really big pullback and it can have a massive effect on an ETF like this. So hopping over and looking at the comparison, this again is another part that I really want to break. ETF.com, this is a great site to kind of do the side-by-side comparison. If you remember yesterday, or I think it was 2 days ago, within the ETF video, we were covering the VanEck Semiconductor ETF or the SMH. We were also looking at the QQQ. And then a lot of people were saying, you forgot the VGT. There was absolutely no need to forget this one. Last traded, of course, the price in this one considerably higher than we've seen with some of the other tech side. But again, price really doesn't make a big difference when you have those fractional shares. But then we start going down and looking at the performance. You can see, though there has been some ups and downs, some highs and lows, when it comes to actually breaking it down, VGT is at 22%. The semiconductor ETF is at 23%. So almost a full percent higher as it sits right now. And this is going back, I believe, over the last year. QQQ 21%. And again, QQQ a little bit higher, but QQQ does have 100 companies, which is heavily invested in tech, but not so much into just the information technology or the semiconductor side of it, which me personally, I do hold the QQQ. I know looking here in the last 12 months, it is the lowest performer, but 2.5%, 3% can make a big difference in the extended amount of time. But you'll also notice that when we have some pullbacks, even here where the VGT -17, SMH -28% for semiconductors. This, of course, was centered around the tariffs. QQQ only pulled back 11. So again, you're not going to have as high of highs as low of lows with an ETF like the QQQ. You are going to see constant growth, but it's not going to be as much. So even thinking of strategy-wise and thinking again, kind of a little bit of a bigger picture, you could invest a big chunk into something like the QQQ. That is going to offer a little bit more stability, putting, 10, 15, maybe 20% into the VGT or the SMH, depending on your age, depending on your risk tolerance, could really make a big difference, because then we start breaking it down again, side by side, which I absolutely love. You can see 5.09, the semiconductor fund, again, outperforming them all in the 1 month and just crushing it in the last 3 months. Looking at the VGT at 14.5, right here we're at 21.75. Guys, 3 months at 22%. That is kind of crazy. Even looking here at 11.93, again, QQQ underperforming just a little bit. Year to date, 13.56. Year to date, 25%, 24.67%. Again, kind of doing incredibly well right there when we see the semiconductors. Then we get into the 1 year though. So again, 27, 28, 26, all within that very short milestone of each other. Then 3 years, the 22, 35, 21. So again, the semiconductors over the last 3 years have absolutely crushed it with a 36% return. But then we go to the 5 year, 19, 29, and 17. Again, that semiconductor fund. And even then, like I said, depending on your risk tolerance, depending on how much exposure you want, something like a VanEck Semiconductor ETF over the last 5 years has produced a 30% return if you had 10%, 5, 10, maybe even 15% of your portfolio specifically in this, depending on contributions, depending on balances, you would have seen it absolutely crush it. I mean, when you look at some companies like Nvidia that are just on fire lately, continuing, which if you bought a single company, Nvidia would probably be the one and only that I would recommend to buy if you wanted to buy just one single company. Expense ratios 0.09, 0.35, 0.20. Again, not really a big difference with any of those. But then when we look at the overall average daily volume, 318 million. Both of these are in the billion range. QQQ, of course, one of the absolute biggest funds. Then we compare the holdings. This is where it breaks it out a little bit. And you can see where when you look at the size and looking at the semiconductor fund, 22% is based in NVIDIA right there with that semiconductor fund. That is massive. Even looking at the information technology at 18, looking at the QQQ 10%, you can see what is really driving this really on these ETFs and how well NVIDIA has performed. So you have one company that is driving a majority of this. And you'll notice though, when you compare really the left side to the right side, so the VGT to the QQQ, they do hold pretty much the same portfolio, maybe adding a couple in here, like we have Amazon in here. We do have a few on the right that are not on the left. And overall, you can see a majority of the companies, even though they're held in more of a concentration in this VGT, they are still present in this QQQ. But of course, it does take out the telecommunications or the communication aspect, because then when we kind of look at what it is, electronic technology, boom, they all carry a technology services. This is where, again, right here, the SMH drops out. And here, this makes up 84% of the electronic technology is in those semiconductors, even looking 53 at the VGT and then looking at the 33 with the QQQ. And you'll notice all of these are pretty much the QQQ. Even looking down here, they do have retail trade, consumer services. So it makes a big difference, again, on the risk tolerance that you're looking and seeing all of them. The majority of what they hold is in that electronic technology fund, meaning, again, it's going to have much higher highs, but it's going to have much lower lows. So depending on exactly what you're investing in, how you want your portfolio to look, and what this buildup really looks like can make a very, very big difference on the performance of these ETFs. Now, overall, guys, when we start looking and comparing the performance of these, it does work incredibly well. There is a lot of risk that is associated with these. Tech stocks are volatile. We have always seen them. They have always been volatile. When the market crashes, tech usually gets hit harder than anything else. 2022, the VGT dropped more than 30% for a majority of investors. If you have a majority of that in that portfolio, it's hard to see your portfolio go down 30%. It could be thousands, tens of thousands, even hundreds of thousands of dollars. But tech is a massive part of the US economy. It's not going to be going anywhere. Really, the future growth is going to come from these larger tech companies. That's why in my portfolio, I do hold 50% of the portfolio in that QQQ. Again, it might not see as much growth as fast, but it still has a very strong, consistent growth, which is well and outperforming that VOO with the S&P 500. So could the VGT make you a millionaire? Absolutely. If you're consistent with your contributions, patient with holding the fund, let the compounding magic happen. When it comes to compounding and compounding within the fund itself, just let it go. Tech has absolutely revolutionized and changed the world, not slowing down anytime soon, especially with AI. Really, I feel like we're in really the infancy stages when it comes to AI. So if you found the breakdown with these ETFs helpful, definitely hit the like button, subscribe for more investing insight, and of course, financial education and literacy. Drop a comment down below. Would you or do you invest in the VGT? Because again, a lot of people wanted me to cover it. Thank you for watching, and I will catch you in the next video.